Welcome, everyone. Get everyone into the room. We'll get started shortly. Again, welcome. Start here in another minute or two. Let everyone get in. Check out our disclosures, the fun thing of any presentation from an advisor, attorney, or accountant. We always have to have our disclosures. Of course, we try to put these together to be as factual and good as we can, but obviously things change and the pace of change accelerates, and there's so much stuff to go over. And so we create all our unique, good, up-to-date content. But again, make sure you talk to your specific advisor or attorney or accountant, etc., before taking action with any of this information, as well as looking it up specifically from the source. Okay. So again, just another minute, we'll get started. Let's go back just here. Now that we got our disclosure out of the way, probably hit it one more time as we start. Welcome to, I think, a underappreciated subject, and for those of you it applies to, is very important. So we're going to go ahead, get started here. So again, thanks so much for joining us today to go over talking about state pensions and pension alternatives, also known as ARP or ORP, alternative or optional retirement plans or programs, etc. And this is a very important choice for faculty and staff, generally at public universities, that gets overlooked a lot. And people don't necessarily make the best, most informed decisions, and it can be a very costly mistake. And so hopefully you're watching this either live with us right now or on demand, and it is timely for your situation and what you're going through, or you're someone that is an influencer on other young faculty or staff, or maybe even later career changers that are coming in to your university, college, etc. So let's go ahead and get started. If you didn't see it before, check out our disclosure. Again, we tried very hard to make timely, unique content, and we're sourcing a lot of stuff pretty fast. So we believe everything is accurate and reliable, but we don't make any representation or warranty. So especially before you make any decisions, you need to consult your advisor or accountant or other tax professional or attorney, etc., and look up the facts from the specific site. So this should give you a great in-depth overview. But again, you gotta do a little bit more due diligence before taking action on things. So I always like to give you a bottom line up front. And our bottom line up front here, really, I'm going to help you understand your retirement plan choices. So the difference between the state pensions and those ARP, ORP that I mentioned in the beginning, and what are the unique features. And there is differences between the different states, sometimes even between the different universities within states. So we can't get that granular. We just don't have the time for it. But I want you to be aware of that, and you're going to get the upper high level view, and then you can reach out to us individually if you want help on an individual plan or decision, or find someone, or hit your chat GPT. Just be careful. It's not always 100% right. Really, a really important thing is don't get defaulted into a bad choice. Generally, at most places, you've got 30 to 120 days to make a decision. And if you don't make one, there's a default. And most of the time, it's irrevocable. And so you could get busy with work and onboarding and whatever it is, and totally be in the wrong plan. So it is important for you, or those or the new people that you're influencing in the future, to know to make a good decision. And then once you've made that, optimize it, right? So understand how choice of providers, how you invest, using brokerage windows. Conversely, if you're in the pension, how the variables are set up and how you can kind of manipulate them and set them to your advantage when you're kind of doing your retirement career planning. And then rinse and repeat. Back in the day, our parents or grandparents a lot of times will go work for one company or institution for the rest of their lives. I think the average now is like 8 to 10 employers, right? So yeah, you're doing this. Kudos for joining this, learning, understanding better, but you're probably gonna have to do it again. So don't just do it once and think it's good forever unless you never change jobs or what so. And I've even had people go from staff and then they go to faculty and they had to re-elect again because they went from like the public employees retirement system into the state teachers, and that's a different election. So you're probably going to have to rinse and repeat, make good decisions continually, and the additive effect of all of those is really powerful. So kind of with this, don't leave money on the table. With pension plans and retirement things and group type of benefits, when you don't make good decisions, you're basically paying extra into other people's stuff, right? That's going to benefit somebody else that did make better decisions. Okay. So, somebody asked a question, and you can absolutely ask questions in between or at the end. If I'm going to hit them later on, I'll probably just tell you, hey, that's coming up. A lot of times I like to answer them in the middle because it's on top of your mind. Even if I don't answer to them to the end, put them in here so you don't forget. We got a question that says, are you going to give us a certificate of participation after this webinar? So generally, we don't do that. If you have a really important reason why you need it, I'm sure we could put together something or even just an email from me as the president that you participated. But our informative live webinars are not like set up for any kind of CEs or CPEs or anything like that. So it's kind of irrelevant. But again, let us know if you need something. Eventually, I think we do a good job on this, that we may start applying for different certification or CE credits from CFP and from CPA board, et cetera, like maybe even for legal continuing education. But we'll see. For now, we're just trying to help people, give you good information, et cetera. So retirement plans, I like people to understand this. So when you work, public K through 12 university, this is pretty much your setup, okay? And you're going to have a pension or the ARP plans, okay? And that a lot of times can work with Social Security or it can replace Social Security, okay? And I made a document, me and ChatGPT did, that kind of outlines the different states and the different programs, whether they work with or without Social Security. I'll share that with you in a little bit. Then you generally have a 403B plan. So 403B plans are your equivalent to 401ks. So for-profits have 401ks. That's a supplemental retirement. So hey, you can save what you want in addition to your primary retirement, which is Social Security. So 403B and your state teachers or your ARP or your ORP is kind of the equivalent. So Social Security plus 401k. For you guys, ARP, ORP, state teachers, TRS, Teachers Retirement System, plus 403B. Very similar type thing. But the cool thing is you have an additional plan called 457, also known as deferred comp or deferred compensation. And so pretty much deferred comp plans are for government employees. So if you worked as a fireman or a policeman or a state legislator, you would only have a deferred comp. And then 403Bs are for nonprofits. And when you work for a public university or a public school, you're both a government employee and working for a nonprofit, which is that unique circumstance of being able to have two supplemental retirement plans. And they have their own nuances. I'm not going to get deep into that because that's not really what this one's about. And there can be other plans that are on there. For instance, OSU Ohio State has a 415M plan. So again, you can read about these things. If you get confused, again, get a good financial advisor that works with faculty or staff and knows your plans. A lot of times they can help you because they're doing it over and over again for lots of people. So keep it on moving on. This just gives you kind of a different kind of view of it. So you're going to have a pension or a pension alternative. You got to choose, boom, boom, if you have the option. which if you're on here, I'm assuming probably you do. And then you can do a supplemental retirement plan and get tax preferences to get a tax deduction, or save Roth where you get all the growth later tax-free to save more than just what the government mandate is for you to save for your retirement. Okay. And so that's what these are. And keeping on moving on. Plan limits, like how much can you save into them? So you can see the full 3B and deferred comp now at 23.5, and there's additional catch-up contributions that can be made over age 50. And then now there's a limited between 60 and 63 where you can make it another catch-up contribution. And then the limit for all of the kind of 401A, ARP, ORP, SEP IRAs, 401ks, $70,000. And then, of course, you can have individual retirement accounts, so IRAs or Roth IRAs, and there's limits. So you can see the employer plans that you're allowed to use and have access have a lot higher limits than here. And also IRAs can get turned off if you make too much money, right? So these can't, even, Elon can contribute the max to his 401k and not get cut off because he makes too much money. So I want to give you this summary. Okay, at a high level, I don't think people understand this unless they've talked to someone like me or gone through kind of a self-education thing, is there's defined benefit plans and defined contribution plans. When you start getting jargony, people call them DB and DC. Okay, so defined benefit plans are your pensions. It's like Social Security. Okay, they give you a guarantee of some kind of specific monthly or lump sum payment upon retirement. Most of the defined benefit plans are based on a formula. So, for example, this is the formula for OPERS in Ohio. You'll hear me do a lot of Ohio examples just because that's where we're out of. We deal with this the most, but we help people with pensions and ORP and lots of different states. But you will see me reference this more than not. But a lot of this, you could just sub whatever your state stuff is or system, et cetera. So final average salary, that's what that FAS stands for. So you take, different states are different. They might take the last or the highest 3 or 5 years with your employment. And so they take that average, they times it, times the years of service, times 2.2%. And that equals your straight life annuity, what you would get paid for the rest of your life, but nothing remaining for the spouse. So it would be less if you chose a joint and survivor. So in this example, say somebody that's average worked out to 65,000, they have 30 years, and times it by 0.022 or 2.2%, it comes out to $42,900 per year, or about $35.75 a month. Okay, so these plans are defined by the benefit that you get in the end. Not how much money you put in, not how much money the employer put in, not what the rate of return was on the pension. It is just based on the formula of what you get in the end. So it's defined by the end or by its benefit that you get. Defined contribution plans are the opposite. They are defined by how much you put in there, how much your employer puts in there, and how much you grow it by, and how long you have to compound that growth. So I kind of put it down here. So you put in all your contributions, times it by whatever rate of return you make, times it by however many years or whatever period you're compounding by, how long it's in there. And that's what you're going to have. You don't have a guaranteed, you can withdraw this much per month or you get lifetime. No, you withdraw too much and grow it unwisely, you can run out of money before you die, right? That account can go to zero. Opposite is true as well, too. You'll grow it to way more than what you need and have a lot left over or have a bigger paycheck. And I'm going to give you some real live examples so that you can visualize that, okay? So let's do poll question number 1. Let's throw it up there. Let's have everybody participate. So poll question number 1. I would prefer a guaranteed low risk pension with a lifetime income. Number 2, a variable risk defined contribution account with the ability to make more, but it also has the potential to be less, right? You're going to have like a wider option, or, I kind of like parts of both. I would like a combination. some states will offer you this because a lot of states have made like member directed, which are kind of like the ARP, ORP defined contribution, as a competitor to people taking their money out of the pension and giving it to TIAA or Fidelity or whatever the case. And then they made a thing where you can kind of do half and half. So it's interesting. And you know what? It doesn't surprise me that more people picked a combination. I think a lot of people, it's tough to decide between these two things, and they just kind of put their feet right in the middle. All right, so in that poll, thanks for participating. But the reality is, it is the lowest participation one. So like in Ohio, I think it's something, I saw some kind of statistics out like this last year. I think it's like 2% of people or something participate in the combined plan. So even though a lot of people like the idea, not a lot of people actually act on it. So we're going to do a case study here. Okay. So these are kind of the fun meat and potatoes of these presentations. So in this example, we're having a career changer. Okay. So somebody, let's say they worked for a private for-profit engineering firm. And, they were kind of mid-level, and now they're switching over to the university to do something in whatever department. They're 53 years old, so they're just coming in. They don't have any, state service prior to this. The salary is $75,000, and they're going to retire at 65. So really like 12 years. They got 12 years to be in the system. And this is just an Excel that I've made and used over the years to help some of our clients, visualize a little bit more. So it's not perfect because we don't know exactly what will happen. And, it's very hard to compare DB to DC like equally because they're kind of apples and oranges, as we talked about. So if you look at this, you could see that person, if they did those 12 years, and just assuming they just got a regular kind of COLA, then when they retired at 65, they would get $19,800 per year or $1,650 per month. So that's not shabby for just 12 years of service. Plus, they're going to get probably their full Social Security on top of that. So for 12 years of service, they're going to get that. When we look at if they were to do the member directed or the alternative retirement plan, and again, I'm using Ohio as an example, you really got to say, well, what does the money grow by? So we could say, say you chose something really conservative with almost a guaranteed rate, and you only made 4%. So over that 12 years, your money would grow to almost $248,000. If we look at the higher side of this and say it grew at 10%, it'd be $352,000 and some change. Okay. Now, what this shows you is, again, this is not like some guaranteed type pension type thing. You just have a pot of money, right? And so if you withdraw at 4% per year, that's a pretty safe withdrawal rate. You have a low probability of running out of money before you die. If you took a 6% rate, then you're playing a little bit more over a 25 or 30 year period. There might be, somewhere between a 5 to 15% chance that you run out of money. Just depends. Okay. But that's kind of like someone that's withdrawing more, like they don't care how much is left over when they die versus someone that's like, I want safe and maybe a little bit of inheritance for my kids or what. So you think about it like that. Again, there's more considerations in that, but you don't grow it very much at the 4% and you withdraw 4%, you only get $826 a month. It's like half of the pension. Okay. If we look at the high side of things and said, well, let's just do 8% because 8% is reasonable, even though the average investor, did only over the last like 30 or 40 years, probably only a little over half of that. So they probably only did somewhere between 4 to 6%. Okay. And so if we look at this and said that they did 6%, they're almost getting up to the benefit of the pension. So this is a very good example. And one of the conclusions that we'll draw is that for career changers and people that don't have a long time to go, but they're late in their career, a lot of these pensions, not all of them, but a lot of these pensions, pretty tough to beat. It is pretty tough to beat versus the DC plan. Okay. And then you can see the vesting. So if you're in OPERS, the traditional pension plan, and you leave, that's what vesting means, is how much of the money do you get to keep? Okay. So, you're going to have some out of your salary taken out, and the employer is going to kick in money for you. So the money that came out of your salary is always 100% vested. It's yours. So when we talk about vesting, we're talking about vesting how much the employer put in for you. And a lot of times the employer puts in more than the employee, okay? And it can be, anywhere between 4% to like 15%. So it could be a lot of money in there. So if you were to leave before 5 years and you got defaulted into the traditional pension, you don't get to keep any of the employer plan. And that's like a 14% contribution. Say were assistant professor somewhere, and then 3 years later you got a tenure track position across the country at this other university and you leave. You just left a decent amount of money on the table back in that pension to subsidize other people's retirement. If you chose to do the ARP, you vested immediately. You had to take 100% of everything with you. If you did the members directed, kind of that alternative, then invest at 20% per year. So say you got 3 whole years in, you would get to take 60% of the pension. Now there's a lot of nuances. So again, when you start making these decisions, you really need to sit down, look at everything. Some of these pensions will do counseling. Of course, they're going to be biased towards themselves. You can meet with a financial advisor, and again, they can be biased as well too, because if you do some of these DC plans where you put in an account that they can manage with, whomever, Fidelity, Voya, AXA, VALIC, they're going to get paid, right? So it's like PERS or the other pensions, they want you to stay in PERS. The advisors that are going to manage it and charge you a fee on it, they want you to be in the place where they can make money, right? So just know what people's conflicts of interest are. It is important. But there are good people out there that do this over and over again that can help you look at some of the nuances as well. So that is that example. So this one really works out strong for the pension. You can see if you did the combined, all the employer money goes into the smaller pension part. So it still has that same vesting schedule. It gets cut in half basically. And then you have your money over here, which is what came out of yours, the employees contribution. And then you can see, grows to a little bit less than half. And so if you put it together and said, all right, 6%, withdrawal over here, then you might be at $12.99. Or well, let's see, 4% at 400 plus 800, 1200 versus 1600. Still, it's tough to beat the straight up pension in this scenario. And you might have had a big 401k from where you were working before. So having a small but kind of mighty little pension to combine to the 401k you had before might be very complementary. Okay. So we're going to look at a number 2 case study here. This one is going to be, we got a question. Someone said, can I change plans later? So this is very dependent on the state system you're in and sometimes even the institution that you're in, and also which one you chose. Okay, so let me actually go back just a second. If you see here, you could be in the OPERS defined contribution, which is kind of like the ARP option, okay? But in the OPERS, Ohio and the public employees, they give you the option, once to be able to switch. So let's say you elected by default going into the traditional, and the next year you learned what I'm telling you right now, and you're like, oh my God, I made a mistake. You could flip to going into the DC. You can't change the past. You have 1 year in the traditional, and now you're going to start building up years here. So this is actually this is an interesting example that you do have the option to switch. Generally, when you opt out of the whole pension, regardless of the states, it's a one-time irrevocable decision. Okay, you're like in ARP or ORP, and you're not changing. Now, if you separate from service for more than a year, there can be variations of what the rule is, or like say you fundamentally change. Like I gave you that example of that staff member that became faculty. So they were changing from being staff and OPERS eligible to being faculty and being state teachers retirement system eligible, and that would get a new election. Okay, so again, if you're in a situation and you think that you may have made the wrong, you need to look it up, get someone like us to help you, and then figure out what the best course of action is to kind of get back on track. Okay, so in this case study, we have a young tenure track associate professor, 30 years old, $95,000 a year, again, going to work until 65, okay? And so when we look at this, so this is state teachers instead of OPers, so it's a little bit different. And even, you could see the variations of some of these. So you can see in with the members directed of STRS, it's 100% vested instead of that over 5 years, 20% per year. Okay, but if she went 35 years here, then her benefit be about $73,150 per year in today's dollars. So again, inflation would make it bigger, but we're trying to make it to where it makes sense to you now in today's dollars. And the monthly amount would be about $6,100 per year. Same vesting schedule. So again, if you're going to leave early, generally you do not want to elect the pension plan or get defaulted into the traditional pension plan. You probably want to do one of these. So definitely for people that are not on a tenure track and you're pretty confident you're going to have to go somewhere else, you need to really think about this. I see so many people mess this up, and it's such a lot of wasted money. So anyways, let's look at this. So if you only made 4% per year, but you're compounded over that 35-year period, it adds up to $1,756,237. Even at 4%, that comes out to almost $6,000 a month. So it's pretty dang close, even at kind of the worst, most conservative assumption. Now, if you wanted to say, again, 10%, I put it on here, but people should not be anticipating making more than 8. You can shoot for it, and hopefully you're making good, wise decisions, but don't be banking your plans on in the future. So 8% is a great rate of return if you can compound that for 35 years. So you could see then it would accumulate to $4,100,000 and almost $9,000. Even at only a 4% withdrawal rate, that ends up being $13,696. So over double what you would get from STRS. And if you wanted to live more for income, it'd be $20,000 a month. So about over 3 times the pension. Okay. And then not to mention that if you don't use all your money over here, you don't have a pot of money. All you have is lifetime income, which, don't get me wrong, that's great. Have a guarantee, especially let's say you're the lucky person that ends up being live to over 100 years old. You kind of won that lottery system, right? Of having that kind of insurance and guarantee for your lifetime. But let's say, you kick the bucket at 85 or 90 and there was 4 million in here. And after you spent down and, took some good withdrawals, there's still $2 million left. Well, it's going to go to whoever you name on your beneficiaries. So these things are fundamentally different. Okay, even though I'm trying to give you comparing apples to apples in terms of this is my primary retirement, how much am I going to get per month type calculation. If we do the combined plan, you can kind of see $3,047 per month, and then you could add the 5 or 8,000 depending on how you're going to withdraw. If you invested wise and got 8%, then you would be at 8 to 11,000 some per month. Okay, so it's not necessarily that you're going to get more or less with ARP or ORP versus the pension. Okay, it really does matter, who you are and your individual circumstances and what the potential outcomes could be. Okay, and so the advantages of the defined benefit or the pension plan, okay, is if you are a conservative, not you see yourself as conservative, you don't like investment risk type of conservative. Okay, so it's just I just want a CD, or I want something that has guarantee. I don't want to invest and take any risk to where I could get a higher reward. Then you could be better off letting the state or the pension system take care of it for you. And that gets right into this lack of investment expertise. If you don't have any knowledge about how to do it well, the resources to manage your own investments, you're not going to put the time into it, then, it could be more reliable, again, to have them take care of it for you. Okay. So again, I'm just giving you the advantages and disadvantages. It's favorable for late stage career changers most of the time. You got to run the numbers and check your specific pension, but a lot of the formulas, because it's defined benefit, are pretty favorable for that group of people. And then you have spousal income support. So most people that we've helped, and when they elect to take their pension and start getting paid monthly, they'll elect usually 100% joint survivor, which means if they pass away, then their wife or their husband continues to get the check to the end of their life, and it's guaranteed. Okay. The benefits of defined contribution plans. Okay. Portability. So portability meaning that you can take it with you if you change universities or jobs, and most of the time it vests very fast, so you're not going to lose anything from some kind of vesting penalty or what. So okay, you have control of your investments. So if you want to invest, like we say over here, for higher growth, you absolutely can. If you don't want to invest in certain types of companies and what, so sometimes you have the power to do that. It depends, again, on your system and how they set up the investment plans, because the universities are generally still in charge of the plan documents and how the plans are designed. But a lot of them are giving you more and more power to customize and pick what you want. If you wanted to invest per, like, say, ESG, which is environmentally, socially conscious, good governance. We have clients that invest, per religious values, like halal, Muslim faith-based, or Christian, Catholic, or Protestant values, etc. And so you are able to do these things in many of the plans. You remove yourself from the government program. So I know a lot of people that are skeptical about how much they'll get from Social Security, or that the states, got a certain amount of the pension unfunded, and what happens if that gets worse. We've already seen them cut benefits and a lot of times take away COLA or reduce it a lot. And so that's another thing, is if you manage it well and invest wisely, you have control over hopefully building it better to have greater inflation protection. Okay. And it's not an annuity, which has its ups and downs, right? It's not a guaranteed for the rest of your life type thing. If they end up with medical breakthroughs and, people live to 120, you have to be a good steward or hire someone of your money to grow it to the right amount, and then to figure out how to take it out responsibly, not overspend it and not run out. But then the upside is that if you do that well, you can make just as much or more how much you pull out, and then there's still a lot left over for legacy type things, whether you want to leave it to kids or grandkids or other family members or to charity, is up to you. Okay. So I put this in here just so you have it. So I made ChatGPT do a deep research thing. So again, I can't guarantee that it's 100% right here, but I believe it did a good job. You'll see at the end of it, there's a lot of references. Again, use this for like a reference if you'd like, and then look it up specifically for your state from the horse's mouth, either from the state pension or from your university or institution's website that explains how everything is. So you can see we get the different states in here, from Connecticut to Florida to Georgia, South Carolina, North Carolina, Texas, Virginia, New Jersey, New York, Louisiana, Mississippi, New Mexico, Ohio, Pennsylvania, Tennessee, Oregon, Idaho, Arizona, Michigan, Virginia. And so there's a good amount of states that have programs like this. So again, not all of them, a little less than half. This gives you it's just really a summary just to help you. So it's like, what is the plan type, who's eligible for it, contributions, how much goes in of your pay versus the employer putting in for you. Do you have this and Social Security, or do you opt out of Social Security and none of your money goes to Social Security and all of it goes into the pension? So you can see here, in Virginia's plan, it works with Social Security and the contributions are lower. And we could see, it's down here, let's show Ohio. there it is, that it doesn't work with Social Security. So if you're a state employee here, you're opted out of Social Security. But you can see the contributions are a lot higher. So for STRS, it's 14% out of your salary and 14% of what the university or what so kicks in. Okay, so reference to this, hopefully it helps you at least just get a broad outline of things, or just to see which states are which, or maybe you are younger faculty that's going to eventually move to a different state, and things are going to change, right, as you go through. Poll question 2. Let's throw it up there. Let's do another question. So, which statement is most true for you or to you? I prefer a low-risk pension, and I trust the pension system to be a good steward. Number 2, I prefer a low-risk, not highly variable, but I would prefer it to be managed by myself, or of course you could hire a professional manager. Number 3, I prefer variable risk managed by myself or a professional manager, in which I can have the potential for higher returns. 4, you really don't know. Like, it's just tough to choose. So let's see what you think. Looks like so far it's mainly split between 2 or 3, which again, I don't know demographics on here. So if it is more younger people, we see this a lot more, especially people wanting number 3. Okay, let's close that out. Thanks for participating again. Okay, so I'm going to give you a brief kind of primer on, how to handle your DC plans. But Dylan will throw up in the chat. We had, if you check out our past webinars on here, actually, let me refresh this. If you check out our past webinars on here, you'll see down here, where was it? Advanced strategies and investment management for 403B and 457. So I go into a lot more depth on it. That's worth watching if you want to optimize how you're investing or managing those accounts. I'm going to hit probably about half the content, but at like 2 or 3 times the speed. So it's not near at depth. Okay. And then we also had one farther back, maximizing your university retirement, which was a little bit more basic and high level than this, the one that you're in today, straight up on the ARP, ORP. Okay. So check that out. So let's see here. Yep. Good job posting that, Dylan. Appreciate it. So let's keep moving. So the thing is, a lot of institutions, even private companies on their 401ks, have been optimizing their retirement plans to reduce liability, or being able to be successfully sued, versus just trying to build awesome plans that are just low cost and have great investment options and have people like us to be able to help you with that. Okay. And so a lot of them have reduced their plans, investment options. I mean, some of them had great, like up to like 100 different funds you could choose from. And now they've just slipped it down to 10 because they want to put less things in there that you can hurt yourself with it. Okay. Because there's always, that weak link in the chain that's just going to try to put all their money into the guaranteed thing and gold. And then they wonder why they only made 4% per year when the S&P averaged 9. And then they just try to blame and sue the employer, right? So I'm telling you why they did this. But it sucks for those of you or us that would do a good job and be wise with the extra choices. Okay. And so that's, they're limiting that choice. And then they are very much optimizing for low cost versus value. So it's kind of like buy the cheapest thing. It's tough to get sued when you got the person like the lowest cost thing. But the lowest cost thing is not always the best thing, right? We absolutely want to go down, and you want low cost things, but the lowest is not always the best value, right? And then they're outsourcing their risk and responsibility, so they'll hire different consultants and this and that. And so then I've just seen a lot of different quirky things happen with plans at different universities. And even like in Ohio, like OSU is so different, and in my opinion, worse than most of the other universities in the state. And they just had a totally different consultant that I feel they just totally messed up their plan. Not totally, but it's not near as good as even say like OU's or University of Cincinnati's. So anyways, one thing that they have done though is a lot of them, not all of them, but a lot of them have added brokerage windows. And this is kind of a bow to some of the more sophisticated employees that they might have, from professors to doctors and what so, that would be unhappy that they just have 8 investment options and some target date funds. And so what that allows you to do is, like, for each account, say you've got the ARP or you got a full 3B, you've got that account that has those funds in there, and that's where all your money goes in. But you can also open up kind of a shadow account, and you're allowed to move money from your main ARP over into this brokerage account, which is still your ARP, but they have to separate it into a different account. And they have different rules. It's usually somewhere between 50 to 100%. I see 50 more often than not, just because a lot of the fees come out of the traditional one, so they don't want all the money moved over to that brokerage link. And inside the brokerage window or brokerage link, that's what Fidelity calls it, then they've got like 10,000 different funds you can choose from. You got to be careful, just because, again, you could hurt yourself investing in the wrong things. You could pick expensive funds. A lot of times people are not paying attention to the cost of the funds, and you might get out of something that the employer optimized for you at 0.1% and load up on a bunch of funds that are 1.2%. And even if they did do a little bit better, and that's great, the manager did a good job, but they only outperformed by 0.25%, you still lost money. It doesn't matter. I mean, versus the opportunity cost, right? So you see a lot of these. Fidelity does it a ton better than TIAA. Unfortunately, I like TIAA a lot, and their base plans are great and they're good, but they are just not the best with technology, and their brokerage window just kind of sucks, unfortunately. But sometimes it's the only choice for the low cost provider, and we got to make do with what we got, right? So we have a lot of money that we help our clients manage with both TIAA and Fidelity. Okay. But you'll find brokerage windows even in corporate 401k plans and what so. They can be a great option to use, even if it's only 50%, because you can keep like your large US and your bond and maybe like a small index fund. They usually have those options pretty decent in the core, like 8 that they left. And then the other things that you need, maybe like some medium-sized growth, or better international or emerging markets, some different types of fixed income or bonds like high yield and international and emerging markets. You can kind of round out to get those eggs in different baskets, generally, like you need to build a more optimal portfolio. And so, again, like I said, expanded investment options, that is the primary benefit of it. The biggest drawback is it makes it very complex. It's hard to manage. It's hard to keep track of. It takes TLC every year to move money back and forth and, to rebalance so that none of your stuff gets too big. So you want to buy low and sell high, right? And maintain risk and, buy some things that are on sale. So, having 2 different accounts that you got to move money back and forth and get out of this fund and into that fund. And if they change fund lineups or whatever is available, it gets complicated and people just mess it up. Etc. It can be higher fees. And again, a lot of people are just looking for funds and looking at the 3, 5, sometimes the 10-year, and they're not comparing anything else. And that's not necessarily the best way to choose funds. And so it takes due diligence. And so, it's work. It is some work to do it yourself. Or it costs a little bit more to hire someone like us to layer on there to do that work for you. Okay. So you got to weigh the benefits, drawbacks, and determine if it's right for you. So some best practices here. Don't chase returns. This is the biggest mistake that investors do, besides some of the behavioral things of selling when the markets are crashing or whatever the case. But again, most people, they will just look up the investments. They look at the 3 and the 5 year, and whatever's the best, they think that's the best fund. And they're not understanding like what's happening in the rest of the world. Is this a short or intermediate term cyclical thing? A lot of times it can be an expensive fund that's having a good run. And if you get we call it reversion to the mean. Statistically, it just means get them back to average. So if you have somebody that's killing it and then they come back to average, it just means you bought in high, right? And so chasing returns is most of the time. Not that anything can't work in certain periods of time, but it tends to be a poor investment strategy. Make sure you're cost conscious. So again, you don't got to be cheap, but look for good value things and don't get suckered into buying the most expensive. Okay. And then proactive management. So you don't need to be trading all the time, but you do need to rebalance your portfolio and make sure that the eggs are balanced how they're supposed to be. And if it's been a while or the markets have really gone up, you need to take some off the table. If things are going bad, I know you might, like I said when I started this section, want to get out, but usually your bonds will have gone up and your stocks went down. You need to rebalance and take some of those bonds and buy some of the stocks lower. And then avoid concentration risk. I mean, a lot of people are concentrated right now if you have investments because they're mainly in like S&P or large US, tech growth stuff like the Magnificent Seven in Whatso. And so people are concentrated. It is a majority of investors today are concentrated, even though they think they might be diversified because they've got a S&P 500 fund or a total stock market index fund. You need more small companies. You need international. You need bonds. They may not look sexy compared to the 3, 5, and 10 year of those large US. But again, these things tend to come back around over longer periods of time. Got a question. It says, what's the best provider to use for my ARP or ORP? So it really depends on what you want and I'm going to show you just some examples. I guess I can kind of hit into it now. But like when you look up your stuff, you'll probably have something like this. So here's University of Cincinnati. This is in Ohio. TIAA's got this website for them, and they can enroll from here. They can look at the investment mixes, how it works, etc. Sometimes you go straight to the university's website. It's probably best to hit both, right? Because they're going to give you a little bit different information. Make sure everything jives, you understand it, etc. I would say the two most prolific are going to be TIAA and Fidelity. They will be at almost every university. And TIAA has the edge on that. Of course, they've been around doing retirement plans for faculty before Social Security. Okay, so they're embedded in most school systems, especially higher learning, with more of the K through 12. In the past few decades, TIAA has kind of retreated from there because Voya and AXA and Balic, Lincoln, etc. They just have more boots on the ground. They make friends with like the treasurers and the superintendents, and they end up being like the biggest provider, and they actually send agents into there. And so then they end up with most of the market share. And since TIA's fees are so low, they're just like, well, if we're not even going to get 10 or 15%, it's not even worth our time to be a provider here, unfortunately, because then there can be an absence of low cost providers, right, for the people that want to DIY it, do it yourself, versus paying an advisor or an agent or whatso. And so I did put we'll hit it at the end, a cost comparison of different providers. The more expensive ones, they have come down in price over the last 10 to 20 years. I mean, I used to work for AXA before I started this company, and prices have come down. And for people that, when you invest through that company, you get an advisor. Now, hopefully they actually do their job and they take care of you, etc. But it could be well worth it in terms of picking the funds, rebalancing, get an investment advice, and kind of your account is paying for it for you for all the extra stuff that you get. But you definitely don't want to choose one of them if the advisor's not doing their job and pulling a good lift. You want to be in Fidelity or TIAA because the costs are going to be half or even less. Okay. So again, I did a lot of these where you can kind of see, getting the gist of the different universities, states, what their pages look like, the different promotional materials that they'll put out to try to help people understand. But it's heavy. It's a little bit of heavy lifting. You can see on most of these, you see on TIA and Fidelity, they're the mainstays. They're probably double as much as anywhere else. So especially if you might switch universities or whatever the case, you're probably safest going with TIAA, but it's pretty close second on Fidelity. And then especially if you want to use the brokerage link, then you're going to get more flexibility with Fidelity as well. And it's not like if you say you had Fidelity at Ohio State and then you ended up going to Texas and you're just going to go into TIAA, you absolutely can do that. It's no problem. So you would just roll over your Fidelity into there, or you can roll over your Fidelity into an IRA that you have at Robinhood. Not that I would recommend that, but you could. Okay. LSU, you can see there's three main. This is another TIAA site, and some of them are different depending on the universities that you're looking at, and you can learn things, and you can even look at other universities that are close to you if your university doesn't do a good job explaining it, and again, you can try to find people like us. Okay. And so yep. And so here's OPERS, which is our staff kind of public employee retirement system or pension. And so going to the pensions themselves have a lot of good information. It's a lot though. Okay. So I can't tell you exactly what would be the best, but you're probably most of the time it's going to be like TIAA or Fidelity. Okay. All right. So custom investment strategies you can do in brokerage links. So like I was talking about before, you can do values-based, you can do religious-based, momentum-focused strategies. So if you do want to focus on more tech or growth-oriented investments, sometimes you're seeing now they're making ETFs even with like crypto and stuff in them. Now, by all means, do not put all your retirement stuff in something speculative and concentrated like that. But to have an extra egg in a basket that's small and you rebalance, it could absolutely help you. And so it's nice to be able to at least have the choice of doing that. And of course, I have my own beliefs based on everything that I've studied and researched and helped with people over decades of how I think an asset allocation should be. But someone might be different, or you might want to be different, even though you still want to have your eggs in different baskets, and you will be able to do that, right? Versus just taking the default target date in the main plan. And so, tap into other things. So like I was talking about before, like a lot of these plans now, they might have a small index fund. I've seen some without even a small cap, mid cap fund. I've seen some where they try to cut it down so much they do small/mid cap fund, and that's all there is, which ends up a lot of the time being mainly mid caps, and you don't get exposure to small companies. And so you can get you could get small growth and small value, and then be able to rebalance, and mid growth and mid value. And so you will get that diversity. And international do horrible on this. Most plans now don't even contain an emerging markets option anymore. So you're not even going to get the opportunity to invest in China and India and South and Central America and Eastern Europe. And I know right now it seems like a dumpster fire over there in a lot of these places. But again, things go around, and go in cycles. And at some point, the United States is going to cool off for a while and the international is going to do awesome. You're seeing the dollar really fall off right now. And most U.S. stocks, are about flat to a little bit negative this year. And international's up like 15, right? So again, this is a perfect example of that. Fixed income diversity. Most of the plans now only have like a core bond, and they don't have high income or high yield. They don't have floating rate. They don't have securitized debt. They don't have international. And there's all those different types of international debt. They don't have emerging market. And you can get these things as long as it makes sense and you get it for a decent price, and it fits into your portfolio, because you want different eggs in different baskets, because we want different things that go up and down at different times. And that helps us be able to buy low, sell high, and also maintain risk if we build it right. And then, as I mentioned before, incorporate alternative investments. So real estate, commodities, hedge funds, crypto, etc. So you can find professional help. Okay, so there are certain firms like ours that specialize in helping faculty and staff and really have a good partnership with Fidelity and TIAA, as well as knowing your pensions and helping you make the right decision of which one to elect, and then making sure that you optimize things. So if you don't feel confident in it, then find a partner. Okay, we would love to help. Leveraging low-cost providers. I think I already hit this with the question. So usually Fidelity and TIAA are the low-cost providers. Vanguard used to be in there before, but Vanguard's kind of retrenched back from the actual plan level and mainly just doing funds. And so their mutual funds and their ETFs, they want you to buy those inside of TIAA or inside of Fidelity, not necessarily be the provider. And so a lot more people than do should have probably professional help. Unfortunately, only about half the universities do what's called fee billing, which means that they'll allow you to pay us out of your account. And the benefits of that is, because most of them are pre-tax, is it's kind of like you get a tax deduction if our fees are allowed to come out in there. So it's like you got a tax deduction when it went in there. When you pay us from your account, it doesn't cause any taxable anything. And so it ends up being beneficial that way. Plus, a lot of people end up with a lot of money in their retirement accounts and they just can't afford to pay out of pocket, right? So fee billing is an important thing. If you're watching this and your university doesn't do it, especially if you are a decision maker, this is absolutely something you should enable. And a lot of times firms like us that are registered investment advisors that bill this way, we're the only fiduciaries in the plan besides the employer itself, meaning we have to look out for our clients' interests before our own. And it's unfortunate that they box out really good financial professionals from helping faculty and staff that really have the legal responsibility to do right. So I'll give you a little bit of an example here, a cost comparison. So you can see, so they're all pretty close when you look at them, and these are the biggest ones nationwide and some as well too. So VALIC, AXA, Lincoln, Voya, they usually will have a platform fee. Most of the time they're annuities, and so they'll call them M&E. It stands for mortality and expense fee, and it could be anywhere between 1/4 to 1.5%. I would say the average now, I mean, it probably used to be like 1.2, but like I said, it's come down some. Average is probably about 1% now. And then you got wildly different expenses on the funds, anywhere from 1/4 to 2%, right? I'd say the average probably is somewhere, 0.7 to 1% or so. So when you look at, hiring one of them, you're generally looking at almost 2%, okay, is about what you're looking at. Okay, with TIAA and Fidelity, there's usually no platform fee. Sometimes they have really small ones, but usually there's not. And then they have their fund expenses in there, which still have a wide range, but tend to be lower. And let's say on average, it's about 0.5%. So if you're going to DIY it and do it yourself and choose the low cost provider, you're on average, if we put everybody together, you probably be at about 0.5%. Okay, but you'll have some people that are over 1%. You'll have some people that are down 0.1 something percent using Fidelity's index funds inside of there. Okay. And then if you were to like use an RIA like us, you're still going to have that spread for the platform fee. Then you're going to have an advisory fee. Okay. It can be anywhere from 1/4 to 2%. The average in the advisory world is 1%. Our average is, somewhere between 0.6, 0.7%. And so, and then our fund expenses are generally about, depending on whether it's Fidelity or TIAA and which plan it is, it's somewhere between 0.2 and 0.6. So I'd say on average, our firm is probably like 0.35. So for us, you're in under 1% with professional help. But I would say on average, it probably is close to 1.5%. So still, it's less expensive than going this route, and you get a fiduciary. And if you find somebody that's pretty competitive like us, you can almost cut the costs in half. But it's still more expensive than doing it yourself, right? Okay, we've got one question and we're almost out of time. It says, what about healthcare if I'm not in the pension or will retire before 65? So if you're close, then you need to really do some planning, because you're probably going to pay out of pocket, but there could be benefits that you're eligible for. We need to look at what the spousal options are. A lot of pensions have been slowly backing away from their health insurance or making it less. We may have to buy from the exchange. We may do some COBRA, then buy from the exchange, or buy a private policy. So we have to look at all the different options. You may have carried the insurance, but your spouse is not going to retire for 2 years, and you never use their health insurance because it was more expensive and not as good, but it still may be the best option versus the other for things that I talked about. So that is a very individualized question. It's solvable. We do this for people all the time, but you definitely got to plan it out, think about it, figure out where the funds are going to come from to pay for it, maybe overfund an HSA or something beforehand. But again, that is a very solvable problem that has a ton of different solutions depending on you, where you're at, and family and work, etc. If it's way in the future, who the heck knows? I mean, we could end up 10 years from now with universal health care, and this is not even a question anymore, right? Because one way or the other, it's Medicare for all or something like that, right? I'm going to skip this again, hit that 403B 457 advanced strategies webinar, and I dig into it a lot deeper. Check us out. We would love to help. We're a pretty no strings attached type firm. We work, at your discretion. We don't have termination fees or cancellation fees. You can see what our clients say about us. We have the ability for you to join us for free all the way up to our gold. And there's like 6 plan levels in between where we do comprehensive planning and help with taxes and estate planning, etc. So if you do need help, check us out. We also do other expanded wealth management, like help with cash and liabilities and college planning and tax planning and business planning and coaching and consulting. People that own businesses, will help them with their bookkeeping or their payroll, save them a lot of money. A lot of times it ends up being a good deal, kind of consolidating with us. We're a very different company. So you can see some of the things that are different about us in terms of being a B Corp, caring about all stakeholders. We're still a for-profit company. We do want to make money and take care of our families, et cetera. But we believe in taking care of our clients and our employees and our country and our community. Pretty cool. So this is a lot of our team right here. If you do contact with us, you use lots of our different advisors or coaches or investment specialists or client service, marketing, technology, etc. I think we hit most of the questions as we went along, so I really appreciate the participation. And again, disclosures, we think everything's right in here, but still look stuff up, double check, talk to your professionals. If you don't have one and you're going to make important decisions, get one or two, get some help. Definitely don't want to make mistakes that are irrevocable. Thank you very much for spending some time with us. We appreciate you. Join us for a future one. If you're watching this on demand, put in your questions. I will respond to you individually by email or video email response. So you'll get those answers as well. So have a great rest of the week. Happy spring. See you next time. Bye-bye.